Hi, I'm Ephraim Lindenbaum. I'm the managing director of Advanced Ventures, and I'm a recovering entrepreneur. So I started on your side of the table, built a company and exited here in Silicon Valley. We've been investing since 1999. In fact, I've been investing with Bill longer than anybody should know. And in turn, we invest across technology, health, and wellness. As you can imagine, since 99, it's been a lot of evolution. We invest today very much around the AI aspects in many of those areas I mentioned.
Ephraim, my oldest friend. We've known each other for a million years. So Ephraim, I was, you know, if you put that together with where the market is right now, right, and the market is frothy, so here and there's these events that really takes down the market by $1 trillion and then it goes back up. Um, what is what, where is the congruity of these things, right? Because let me paint the landscape. Since the election day, we have seen a floodgate of deals in M&A transactions, in financings, and frankly, some of those financings were down round financings, and so it's not a happy thing. We just kill this thing, um, and then you have all this, you know, frothy market at the same time, and you have this uncertainty going on that part of this, executive orders have placed. Where do you put all this together? I mean, how do you see all this shaking out, or is it a second quarter thing?
Yeah, I mean, I think that the underlying issue is the exit opportunity. We have planes backed up, venture deals backed up for 5, 7 years. Last time we saw this was coming off the 2007, 2008 collapse cycle. And until the 012, 013 IPO boom and the liquidity, everybody remembers Facebook and LinkedIn and many of those companies kind of coming out after a long drought. We're very much in that cycle. And what tends to happen when you're backed up that far is it pushes down across the whole space. It's been challenging for liquidity. It's been challenging for venture. And what we've really sort of seen here is kind of a P.T. Barnum story in venture. There are a few entrepreneurs that are really good at raising money. They hit some amazing dollars and valuations, and then everybody else suffers and dies underneath them. And
Are you talking about Sam Alton?
I mean, we see them all the time, and somehow many are successful, and I don't know, and we bought into a few, and some have been successful for us, but in general, the market's been very, very, very tough for the last 18 months for a lot of startups. I mean, we tend to have a much larger focus on companies having customers and revenue. We're so old that what today is seed round used to be A rounds when we did them. I mean, I did a B round. I did an A round with Bill years ago that would be a weak seed. You guys would be like, I don't even want that. So it'd be a pre-seed, yeah, and most people would just walk away. So I think there's a lot of that involved. So the exit trajectory is very meaningful, and then we've got all this disruption on AI happening. And I didn't want to bring it up, but I don't look at it in this sort of frothy AI story because we had an exit in AI in 2004, and I thought that was great. We put that in the can. We're never going back there. Here we are again. So it's like the third or fourth coming of AI. It's just going to make things a little easier. It's like the Java of all your generations. I mean, just put it in and we'll all just move on. If it was a great idea and people really cared about it and customers really want it, we'll pay you money. Give us a ring.
And Ephraim, what's the best company you've ever invested in? What was the blockbuster?
Well, that's like asking which kid you like best. You can't do that.
No, but but there's a valuation. There's a public markets.
Look,
The sales price.
we just wrapped up our first exit of 25, so I'm just really on a
Fantastic.
happy move. So, yeah, I'm actually going to flip the script and do a little AI lecturing here to everybody. So, all of the AI is great. People like Bill and I and most of the other panels, we've seen wave after wave after wave of tech come through. And the thing that I think you really need to keep in mind, if you take away a few key data points, one, product. Jennifer was talking about it, her firm, everybody's talking about product. Two, customers. They're really important. If you don't have any of those, it's difficult. And then the last one, and this, this is a biggie, but revenue. You need to get those. Take those 3 words, put them above your desk, and then while you're thinking of all these great AI things, make sure that those 3 things apply to those things, right? And then as a founder, I mean, we have sort of 5 tenets, and you can mix them up in whatever order. I always mix them up depending on the crowd, but these are the things that you should be thinking about as an entrepreneur. Authenticity, big one, honesty, transparency, conviction, and tenacity. Okay. So those are the things that, put these things on the wall. And when you come to us, make sure you're exhibiting all those pieces, not just a great new AI thing, not a great other thing, because oftentimes by the time you're at an exit, there's the next thing, whether it's quantum computing or something else. And you're going to need to pivot just like we've all pivoted. So embrace those things and then apply what you're doing with that underlying current.
Can I? So at the end, you're just talking about these are fundamentals. That has not changed.
Right. AI will not pave over any of those things. So, I mean, I really want to bring you back to that because great companies get built based on these types of things, right? And, don't get lost in the noise. You still have to do all these things and have a great AI or health or whatever other app you want to do. But don't lose sight of that.
Yep.
How do investments look like, ROI, or the sizes of your investments?
Well, yeah. So, I mean, I think one of the biggest issues is venture has been holding very tightly onto the capital. And what is going to happen, I mean, we sort of have an internal issue where we just basically do X amount of deals per year and we just force ourselves to do it. But many other firms have really pulled back on that. And what ends up happening is as the investment period of a fund tends to come to a close, money starts getting thrown around quite a bit. So that's something I think we all need to kind of keep in mind as entrepreneurs, that we are running up against some time cycles, especially in specific categories. So keep your eye on that one as well.
But what are you doing to help, and why should they be investing with you anyway? Because the good ones, they do have choices. So
yeah, I mean, I think one of the most important things that anybody needs to do is understand us. And in order to get money from us, you got to understand us. And I think there are firms that are highly focused on BD. There are other firms that are otherwise. I think the biggest thing is we've seen a tremendous amount of Gen Z founders expecting us to do a lot for them. And that has been a real challenge. And I will tell you that, we're not going to do anything for you. If you say, I've got a hyper-targeted shot that I need you to take from me at Merck or XYZ company, and I know you're connected, and that board member plays golf with your friend, then we're happy to do that for you, right? But we're not going to, go sell your product for you. We're not going to help build your product. I mean, we want to essentially, we're the secret weapon that you pull out and you got one big shot with us every once in a while. If you use it wisely, you get a new one right away. It refreshes. So, that's what we look for.
So,
Hi, I'm Steve Chinani. I particularly liked Bill's comment when he said that product market fit is not the be all and end all in entrepreneurship. I think that's more relevant even in healthcare, like you said. When you invent a new molecule or a new radical invention, you don't even know if there's going to be a customer. You'll never know. So at what stage and how are you ever going to raise capital when everybody looking to invest in you is going to say, well, prove the market. Well, you're going to create the market. You're going to create the product market fit. You have to actually build it. So I'm talking about radical innovation, which is really what the VC industry was all about in the original days. People came in, invented a new semiconductor device, and they got funded. That was radical. There was no market for transistors at that time. So my question is particularly puzzling, I think, in terms of a lot of entrepreneurs out here who, and I've been on both sides. I'm an angel investor, and I've done 10 startups over the last 30 years and had 2 exits. But I would say that for a lot of entrepreneurs here, I think the puzzling piece is, I've got this great idea. I'm going to get turned down by every investor because I cannot prove product market fit. It takes the prior art to the next level. So how should they position themselves, or at least, coming to investors to get to a successful outcome as far as funding is concerned?
We invest in food companies. In fact, if you go to Safeway, Alpha Foods, burritos, they're all over, right?
The dog,
That is
the dog
the
food,
most,
right?
yeah, that is the most effective product fit model you have. You actually send a tester to a grocery store with a product, and there's either it's all gone or it's not all gone. And so if you think about it, that's like binary for all of us, and then it goes all the way into slicing and dicing and slicing. So you're asking this like epically broad boil the ocean question now. You have to really dig into exactly
Yes.
what. If you're doing drug development, we're talking molecules. If you're
Yes.
talking burritos, I mean, it's just how much they eat.
Ephraim, I know you talked a little bit about how Gen Z founders are a little bit different than their counterparts. I'm a Gen Z, and I have a bunch of friends who are developing companies as well in the same age group. And there's this other tendency that I've seen is different as well, which is pivoting. So they would start with one thing and then move to the next hot thing in like 2 months or something. So I just wanted to know how open are VCs to pivoting, like changing the whole track altogether.
Well, I mean, that's an incredible skill, and we really do look for the ability to pivot as a founder. The difference between pivoting and having sort of ADHD about a product is really important. And again, that is one of the challenges when you look at the Gen Zs. You've got to be able to follow through, and it's really our fault, and the companies we funded, i.e., social media, other things that are out there that have created a very short attention span. The biggest problem is we also have very short attention spans because we're very overwhelmed with a lot of things. So when you put two people with too short attention spans together, it's like ships passing in the ocean. Maybe they'll see each other, maybe they won't. So my recommendation there is I have seen very, very talented Gen Z founders. They're the ones that can find, like what I was talking about, the conviction and the ability to stay with it. And one of the things is that it's highly influenced. So authenticity and conviction mean a lot. And when I was giving those 5 tenets, I was really aiming specifically at Gen Z founders. I was, a Gen X founder at one point, and someone lectured me on all these things too. So I'm just passing along.